5 things that make a good deal. Number 1 is buying from a motivated seller or below market value. Now, why is buying it from a motivated seller or below market value important? Well, because a motivated seller is somebody that needs to sell the property. They need that money straight away. So they're going to be flexible and negotiable, possibly to terms of a sale and the price. Below market value enables you to lock in equity on day one. Now, it doesn't mean to say that if you buy a property and it's not below market value, you buy it as true market value, it's a bad deal, because sometimes the uplift in value can be so significant that it doesn't matter if you're buying it at the market value or below market value. So the second thing is buying properties in an area of great rental demand. The last thing you want to do is buy a property in an area where there's not much rental demand and you can't rent the property out, because why do you buy property? To make money. So you want to make sure that the property is in an area where there's great employment and is close to transport links to the city centre or other major cities. The third thing is to make sure that you're buying properties that cash flow positive. Now, this might sound like such an obvious thing, but what does positive cash flow mean? Positive cash flow is basically where the property pays for itself through the rent, but then once all the expenses have been paid and deducted, you're left with a bit of money at the end, and that's your profit. Now, you'll be surprised, there are some people who buy properties that do not positively cash flow, and they end up having to subsidize the property themselves. And this is always a very dangerous thing, not only because the property is costing them money to run, but also because if the market turns against them, they have to sell that property at a lower price than what they bought it for, so they're completely out of pocket. The fourth thing is to buy property and hold it. So you get two types of property investors: a property flipper or property trader, or somebody who holds for the long term. Now, property flipper is somebody who buys, refurbs and sells straight away, and they look to crystallize their profit. They just get paid once. Whereas in property, you make money on the buy. So through great capital appreciation, the significant growth that can incur is what creates wealth in property. So always hold on to properties, because you can get paid forever. You work once and you get paid again and again and again through rental income and your capital appreciation. And the fifth thing is to always make sure that you have a cash buffer for any void periods. Whenever having properties can always be subject to wear and tear, and they need repairing sometimes. So instead of having to go into your own pocket or your own profits to maybe replace a boiler or something, keep money aside, typically 10% each month. So whenever this type of situation does occur, you have money put aside from the rent to pay for these costs.